Hello and welcome to Principles of Accounting, Chapter 16. In Chapter 16, we introduce management accounting. Management accounting is designed for internal accounting use for the organization. The two main branches of accounting are financial accounting and management accounting. In Principles of Accounting 1, we cover financial accounting. Financial accounting is mostly used for external users. Management accounting, we're going to focus on accounting systems that help decision makers. So we're going to look at a lot of information internal to the company, how we control that information as part of our strategic plan for running our business. For example, how do we control cost so that we can increase our revenues? How do we create our budgets? And then once we create budgets and then run through the month, how did our budgets compare to what we actually did, our performance review? So we're going to look at evaluating and rewarding good performance, where we're going to find maybe if we have problems with our performance, if our budgets were really off, there might be issues that need to be corrected. We're going to talk a lot about using accounting information for decision making. When we talk about using accounting for decision making, we need to know who has that decision making authority within an organization. A department manager often has the decision making authority for that department. They can hire, fire employees, they're in control of a certain department's budget, they're in control of that department's resources, but they might not be in control of everything. For example, a manager might have a small budget that they get to make decisions about, but they don't get to decide when the company buys a new building or moves into a new market or creates a new product. There's someone else with that decision-making authority. We're going to look at a lot of different examples and how different decisions internally with the company make changes to accounting information. We'll see examples from a marketing standpoint, from an accounting standpoint, from a management standpoint, from a CFO standpoint, and how all of those decisions affect other people's accounting information and departments. We need information in an organization. We need both the historical information, so what have we been doing? Historical information is a lot of what we looked at last semester in financial accounting. What information do we already have about what the company is doing? Management accounting also looks at projected information. What do we plan to do in the future, and how much money do we need to pay for those plans? So not only do we make budgets, which is a plan for the future, but we might also say that we want to expand in the future, and then we need to make a decision about where we expand to. If we expand to another market, if we need new equipment, does that equipment going to make us more productive? Are we going to recapture the cost of that equipment? There are a lot of different things. So we're going to talk about the organization's value chain. The value chain is the activities necessary to create and deliver the product or service to the customer. There are a lot of steps in the value chain. When we look at that management accounting framework, in this, see here that we have performance evaluation of historic information. We're going to look at what did we do, and did we do what we planned to do. We're going to be looking at future plans in creating budgets, and we're going to look at our current actual results. These things all work together as part of management accounting to help us make decisions as an organization about how we perform our business. This comparison of financial accounting to management accounting. So we've already talked a little bit about the purpose. So financial accounting's purpose is to provide information about the financial position and performance of the company to external users, to stockholders, to financial managers, to bankers, to lenders. Management accounting is used by internal users to make decisions about how we run the business. In financial accounting, we have financial statements, which we've already learned about. In management accounting, we have other reports, which we'll be learning about throughout the semester. Financial accounting follows US GAAP. In management accounting, for our internal reporting and decision making, we do not have to follow those standard rules. Now, that's not saying that management accounting doesn't follow any rules at all. Management accounting information becomes financial accounting information. So when we make those decisions and we record the financial information and that becomes financial reports, that does have to follow US GAAP. So that's a little confusing in saying that it doesn't follow any rules. You do have to follow some rules in the reporting. In financial accounting, the company is viewed as a whole. In management accounting, we look at different departments, different parts of the value chain. We're going to look at different areas separately. We're going to compare some. And the users. Financial accounting, we have external users, and in management accounting, we're mostly internal users. How customers get involved in management accounting is because management accounting informs decisions about what kind of products and services we offer, the quality of those products and services, and how much we charge customers for them. There is professional certification for management accountants, just like there is the Certified Public Accounting Certification or the CPA. There is also designation for management accounting. The first exam is the Certified Management Accountant exam. There are 2 exams that you have to pass. Additionally, you need to have a bachelor's degree in accounting, business, or finance, and have 2 years of relevant work experience. If you are a certified management accountant, you can go on further to also get certified in strategy and competitive analysis. So we've already talked about what management accounting systems do. We're looking at assigning decision-making authority. Who gets to make the final decision? Who is in control of this decision? Creating accounting information to make and support the decisions that we're making, and then using that information to evaluate our performance and to decide whether we need to change things or whether our performance was extraordinary and needs to be rewarded in the form of a management bonus. One of the main types of companies that we look at in management accounting is manufacturing companies. A lot of the accounting that we're going to be doing over the rest of the semester will be looking at manufacturing companies. So manufacturing companies produce the goods that they sell. So they have a lot more costs in their cost of goods sold. In Principles of Accounting 1, our cost of goods sold was merchandising inventory. In a manufacturing company, we buy raw materials. We have employees that we pay to convert those raw materials into finished products. And we have expenses for the production facility. It costs us money to manufacture those items. All of those components go into the cost of goods sold for a manufacturing company. When we're looking at our cost information, We want to be able to answer all of these questions. These are some of the questions that we're going to be answering as part of this class. We're going to be looking at what sales price must we charge for our products to earn a reasonable profit. We need to know what it costs to make a product in order to determine a sales price for it. So first we're going to look at how we cost products and then how we determine a sales price for those products. Can we make something cheaper? Is there a way to outsource a product? Maybe it costs us $10 to make a component that we could buy from someone else for $8. Should we do that? Does that affect our quality? Is it less expensive to, that's where I talked about, is it less expensive to buy from other parts? Or should we make all of the parts ourselves? We control quality if we make all the parts ourselves, but that might cost us a lot of money. Maybe our customers aren't interested in paying the full cost of those products, and there are ways that we can reduce those costs. Should we automate our production process? Should we buy fancy robotic assembly equipment that costs millions of dollars instead of having a dedicated workforce? And what is the cost-benefit analysis as part of that decision?